Okay, good afternoon, everyone, and welcome to another College and Career Pathways, where every Monday, Wednesday, and Friday we provide you with information on various colleges and universities, financial aid resources, technical schools, training programs, and career readiness skills, all designed to help you make the best career decisions possible. I'm Toni Cureton, your host, and today we are back with Michigan Schools and Government Credit Union, and they're going to be continuing our financial literacy series. And today, Colleen is going to talk about loans. Welcome back, Colleen. Happy New Year to you.
Happy New Year. Thank you so much. Great to see you again. And yes, we're starting off the year paying back those loans we got for Christmas presents and the fun we had over the holidays.
Indeed.
As usual, I have a cute video that kind of overviews what we're going to talk about, and then I will see you in a minute.
Finally some alone time.
Did somebody say loan time?
No, nobody said loan time. I said alone time.
Right on. Time for a loan.
No, I mean, I want to be left alone.
Clearly you're confused about how loans work. I was once that way too, little dudette. But don't worry, I can tell you all about it.
Great.
Loans are like surfboards because there are different kinds to suit your individual needs. Student loans for tuition, mortgages for buying property, auto loans for getting a vehicle, small business loans for entrepreneurs, and payday loans. Although, to be honest, I'm not too stoked on those. They're kind of the worst.
So loans are tailored to the stuff that most people can't pay for up front.
Totally. A typical loan looks like this. There's the principal. That's the amount you're borrowing. Then there's the interest rate. That's a percentage that your financial institution charges you for lending you the money. Then there's the term. That's the amount of time you have to pay it all back.
That makes sense so far.
Righteous. Loans can either be secured or unsecured, depending on whether or not they're protected by collateral. Collateral is something valuable that the lender can take as repayment if you default on your loan and can't pay it back. It's usually something big, like your house or a vehicle.
That sounds scary. Why even bother with a secured loan?
Because secured loans usually have lower interest rates since they're less risky to the lender than an unsecured loan. Don't worry, little dudette. They're only scary if you can't afford your loan.
Are there other ways to lower the interest rate?
Interest rates are like ocean tides. They're influenced by a ton of different factors, and nobody knows how they actually work. Every lender is going to use a different set of factors to see whether or not you're eligible for a loan and what your interest rate will be. Factors like your credit score. Higher credit scores qualify you for lower rates, so it's worth it to get your score in shape before applying for a loan. The loan itself. The more you borrow and the longer the term, the higher the interest rate will be. Then there's your life situation. Lenders look for things that suggest you'll be able to pay back your loan. A good employment history helps. Not having any other debts help. Even having a long-standing relationship with a financial institution can help.
What about getting a cosigner?
Totally excellent question, surfer girl. A cosigner is like a surfing buddy. If you wipe out on your loan, he or she is the one responsible for its repayment. But being a cosigner is as risky as hanging 10 in a hurricane because your credit history can be affected by the loan as if it were your own.
So it needs to be someone who trusts you a lot.
Totally. I have one more surf tip for you, and that's to see whether or not your loan has a variable or fixed rate. Fixed rates stay the same throughout the entire term of your loan, whereas variable rates are based on a chosen index. If that index goes up, so does your rate. If it goes down, so does your rate. Fixed rates are nice, constant, and easy to plan for in your budget. But the interest on those is usually a little higher because the lender has to anticipate that the rates may rise in the future.
Like that giant wave over there?
Oh, surf's up! Later, dudette! Awesome! Rippin'! Oh, jellyfish!
Okay. Oh, I gotta resume share. Okay. Everyone can see where it says loan basics. All right, excellent. Loans are the gatekeepers to some of our biggest goals. And some people, some families, some cultures, some attitudes are loans equal debt. Debt is bad. All debt is bad. It means you owe money. You're negative. I understand, but people are using loans to cover large purchases. I wouldn't be able to buy a house without a loan. Some people wouldn't be able to go to college or wouldn't be able to start their business. So it's not necessarily bad debt. You know, any financial expert will kind of say there's good debt and bad debt. You know, as they mentioned, these loans are looked at differently. So we don't want to look at all loans as bad. They're not. Different kinds of loans. Like in the video, we mentioned the different surfboards. Student loans usually come from the government. They have very different guidelines and interest rates than you would see for a mortgage. The requirements for a mortgage, the interest rates, very different. You could be getting a home that's $80,000. You could be getting a home that's $800,000. You know, that's a large amount of money for any institution to say, yeah, we trust you to pay that back. Auto loan, a small business loan. It could be just to get your little store, but, you know, just to get a space to start working your little side hustle into a real business. It could be opening up a whole nother location of the current business you have. You know, that would be an investment. You know, you're getting a loan in order to allow yourself to make more money, right? Personal loans are, I'm going to take the family on vacation. I'm going to get the kitchen redone. I'm going to pay for my my daughter's wedding. You know, there isn't something that goes with it. It's just money. Now, those are going to be the most expensive interest rates, and we'll look a little more into that. Loan terminology. Basic loan terminology. We're going to look at 3 terms that factor into every single loan. No matter what kind of loan it is, you're going to want to know the principal, the interest, and the term. The principal is the amount you're borrowing. If you are buying a car that's $10,000, or the sticker price, you know, that you're paying for the car is $10,000, that's the principal. That's what you're asking to borrow, right? If you have a credit card and you make a purchase of something for $500, well, the principal of your credit card bill is $500, right? Because that's what you owe. That's the balance. Oh, excuse me. The interest is what is the percentage you are paying on top of the principal, the amount charged by the lender, whether that lender is a person, a small business, a large company, a bank, for use of the mortgage or use of the money, excuse me. The example that I use when I'm in classrooms is I say, you know, you can trust me. You can trust me. Would anyone in here loan me $100? I promise I'll pay you back by the end of February. I'll give you $110 at the end of February. You know, I might be able to convince somebody to loan me the money. But if I said, all right, well, anyone loaned me $100, but I promise I'll pay you back by December 31st, 2023. You'd probably a lot less likely. That's farther away. That's a longer time you're going to be without that $100. So for me to be using that money, I'm being charged an interest. Instead of paying 110, you say, well, I want $130. You know, what is the extra on top of the principal for the luxury of taking that time? And then the term, how long? You know, how long is this loan set up for? There are installment loans with a beginning and an end date, like a car, you know, $10,000 car. When you're paid off, it's paid off. There are revolving loans like a credit card, where you can pay your bill and your balance is zero, but then when you buy something next month, you know, and it's just constantly changing. 48 months, terms are in months. So you might think to yourself, I have a 5-year car loan, but on all of your paperwork, it's going to say 60 month. The term is 60 months. 48 months or 60 months is a pretty standard term, whether it's a car loan, personal loan, you know, a motorcycle, an RV. Once you are talking about a student loan or a house, where we could be getting into tens of thousands, hundreds of thousands of dollars, you might have a 30-year loan or a 10-year, well, 30 years, they start counting in years at that point, or a 15-year loan. So for smaller amounts, usually 4 or 5 years, term is in months, and for much larger amounts of money, they will break it up by year, but very specific terms. All right, secured versus unsecured loans. I mentioned this previously when I was talking about the different types of loans. Any loan is either secured or unsecured, right? It's one or the other. Loans can be secured or unsecured depending on whether they're protected by collateral. All right, well, what's collateral? Collateral is something valuable that the lender can seize, the lender can take as a form of repayment if the borrower defaults on the loan. Now, well, what does all that mean? Let's put it into simple terms. If you went to your parents and you said, there's this new this concert ticket. I really have to buy these concert tickets. I need $150. I promise I'll pay you back by the end of the month. And your parents say, okay, all right, okay, we'll loan you the money. But what happens if you don't pay us back at the end of the month? What collateral are you willing to put up? And you say, well, I guess my Xbox. You know, you can take my Xbox, you know, thinking he'll pay it back. Now, they're more likely to lend him $150 if they know they're going to get an Xbox out of it, right? It's more realistic for him to pay them back to make sure he keeps his Xbox. If your friend says, can I borrow your car? And you're trusting them with your car, you might say, all right, well, leave me your laptop while you're gone. You know, I know you'll come back for the laptop. It's collateral, it's worth something. So it's having a tangible physical object attached to the loan, right? A car, a house. This kind of looks like stocks. Investments could be collateral. If you own a piece of a business or a percentage of a business, you know, that's an asset that's worth something. Oops. A secured loan requires collateral. You think secure, safe and secure. It's safer for the lender. If you have 3 bills in front of you, 200, 200, and 200, you owe $600 and you only have $500 in your hand. And you're like, oh no, how am I going to pay this? Who's going to get what? Well, if one of those 3 bills were an auto loan, and if I didn't make that auto loan payment, my car could be repossessed. I'm much more likely to make sure I put $200, towards that car loan, and then move on to how I want to split these up. If one of these is rent, probably be more than $200. But again, rent is something you want to make sure you pay right away, because you don't want to lose the house. So lower interest rates, they're much lower, they're much cheaper and easier to get, because there is that item, because, well, I'll get your whole house and nobody wants to lose their house. An unsecured loan, like a credit card, you can buy gas at the gas station, you can buy a cup of coffee, and then if you don't pay your credit card bill, what's going to be repossessed? I can't take the coffee, I can't take the gasoline out of your car. There's no physical object. If I borrowed money to take my family on a vacation and I don't pay it back, well, what's being repossessed? A student loan. A student loan is actually an unsecured loan. Now, it's an investment. It's taking out a loan to invest in yourself. I'm going to put all this money into myself and my education so that I will be worth more in the future, right? That's why you buy a stock, because you're saying after many years, this is going to be worth a lot more. However, what if you don't pay that student loan? We can't negate your degree or say, well, you didn't graduate school, or suddenly your transcripts disappeared. There's nothing to take. There's consequences. Don't get me wrong. Do not think, oh, well, if you don't have to put anything up and you don't have to pay it, there's consequences both ways. You want to pay all of your bills. But an unsecured loan, if there is not something attached to it, it's going to be much harder to get. It's going to be much more expensive to get. They're not going to let you take out a 15-year loan on $10,000 because you feel like it, because I just want 10 grand. I don't think it's not going to happen. All right, so ways to lower your interest rate. Like I said, different types of loans have different interest rates, will have different, I should say, ranges. A credit card, you could get a great credit card rate, 9%, average could be, between 14, 15%, but then we have, someone with not great credit, it's going up to 22, 25%. Then we have credit cards from stores like Kohl's. They're going to be like 28%. Whereas if we're talking about a house, oh, good God, if it was 28%, it could be usually 3 or 4%, a very low percent. I mean, think of what 3% of 100 grand is, and if you're paying that interest over 30 years, it's an extreme amount of interest, or extreme amount of money, So no matter what the loan is, you want to pay the least amount of interest possible, right? If you're buying a $10,000 car and you're going to different lenders saying, how much is it going to cost me to borrow $10,000, right? It may cost $10,500 in the end from here. It may cost $10,800 in the end from here. Well, then I'm probably going to go with this lender. Oh, secure your loan. Secured loans have lower interest rates. Let's say you wanted money to pay for a wedding. there's no collateral. You don't have a collateral. There's no wedding, collateral to put up. And they're going to give you like a 16, 17% interest rate. That's really high. You're going to be spending a lot of money on interest. So you're thinking about it and you're thinking about it. And you're like, I paid my car off a few years ago. And I enjoy not having a car payment, but you know what? I'll put up my car as collateral for this loan for the wedding. So the money is being used for the wedding, but regardless, what's written on the paper is if you don't pay this loan, the car will be repossessed, right? It's, there was a discussion and an agreement come to where I'm offering something as a secured loan. You might say, I'm going to put my summer house, my up north cottage up as collateral. So even if the loan isn't specifically for that tangible item, if it has value, you might want to offer it up as collateral to make an unsecured loan secure. Only borrow what you need. This is hard to swallow. This is hard to hear. Having money available to you is great. It takes a lot of self-control. It takes a lot of willpower. It takes a lot of mistakes and a lot of recovery to really understand you do not want to borrow more than you need, right? If you can't afford it and you're borrowing it just for the sake of getting it or just because it's available, that's the bad debt. When someone's, if you're getting a student loan and tuition is only going to cost you, and we'll probably get into this in a few weeks, tuition's going to cost you $20,000, but you're offered $30,000 and you're like, oh, great, I can use that $10,000 on myself while I go to school. Okay, well, the interest on $30,000 is going to be very different than the interest on, $20,000. You're going to be paying a ton more. Only borrow what you need. Do not borrow for the sake of borrowing. Come on.
Pauline, can I ask a question regarding that?
Yes.
So if a student is coming to the credit union to take out money for their tuition, student loan, so each year they have new tuition amounts. Are they automatically able to come back the following year and take out another loan for that semester's tuition, or do they have to have the first loan paid off before they can come back?
If you're talking about coming into the credit union and asking, it wouldn't be counted as a student loan. It would just be a loan. I wish we could offer student loans, and we'll get into it more. When you get the loan from the government, there's a lot of flexibility. You have a longer period of time. You have the ability to defer it or go income-based. Whereas if you're getting a loan from a financial institution, it's just an unsecured loan and your payments start right away and there's no deferment. So it would be as if you were continuously asking for a series of small loans, and I wouldn't recommend that as a route. And I'm sure the credit union representative would try to talk you into maybe getting a large amount at one time to start paying on, or to look at other financial institutions that do offer loans that do offer student loans that aren't the government. Does that help?
Okay, so then in other words, what you're saying is a financial institution, whether it's the credit union or a bank, they are not going to be issuing a student money every year to pay their tuition. They want that student to take one big loan, which should cover their tuition every year if they budget and plan things out correctly.
That would be the logical scenario. I wouldn't make that your first stop. But if you need to go that route, or if that's the way you go, yeah, it would be either a line of credit, that would be, yeah, a bulk amount. So
Okay.
you've got to be careful and don't spend, don't spend it.
Yeah, absolutely. Thank you.
Sure. Boost your credit score. And again, this is something we're going to get into in a lot more detail, but your credit score is basically your adult GPA. It's a number that represents you. You can't be everywhere all the time. So someone's got to look at a piece of paper and say, oh, Colleen Godfrey, well, let's see, should I give her this loan? She's paid back these loans in the past. She's never been late. She's always paid more than the minimum balance. Well, everything seems great here. Well, I guess if it's score, she has a 750. So based on that number, you're more likely to be approved. You are likely to get a lower interest rate. It's trustworthiness. The higher your credit score, the more trustworthy you appear, the more creditworthy you appear. And your reward for that is a little leeway, is a little flexibility, lower interest rate. You might be able to take it for a little longer. And know what lenders look for. If you are looking for a home or looking for any sort of loan, do some research first. The financial institution shouldn't be the first stop. Think about it. Okay. I'm getting a car. Well, how much can I pay monthly? Where is this income going to be coming from? Am I willing to lose this car? Build up your credit. If you talk to someone, let me back up. You can go to the financial institution, but you want to put yourself in a positive light. You want to make sure that these pieces of paper say positive things. Oh, you have experience paying some debts. You have experience paying off. Paying off debt. You want to kind of prepare a good report before you go apply for it. Getting a cosigner, that may be necessary. It may be necessary for approval. For instance, debt consolidation. If you are trying to get one loan to pay off other multiple loans, some places are like, oh, well, that just seems like trouble. That just seems like you're going to get yourself right back into that situation. So no, we're not going to loan it to you. Well, maybe if I have one of my parents who has a lot of assets, they if they're on the contract, they have to pay and they know there's money there. So yeah, it'll get approved if I have someone else's name on it. Student loans, sometimes you can't get $100,000 loan to you at, age 18, 19. You might need someone older with a better or higher credit score in order to do so. It may just make things a lot easier. It may make, for example, if I try to buy a house with just by myself, I might get 4.5% interest rate. And if my husband and I together, they look at both of our reports and they decide, oh, well, with his name on it, we're going to get a 3% interest rate. Oh, well, good. Well, then in that case, it will benefit us. But both parties have to understand that they're responsible. It's not well, I just gave him my name. Both parties are 100% responsible. Something else that was mentioned that's extremely important and often forgotten, you get so caught up on the interest. What's the interest rate? I want a low interest rate. That's important. But is that interest rate fixed or variable? A lot of people don't think to ask that question. You know, why does it matter? Well, fixed, something fixed in place, a fixed position, you know, fixed point. It stays the same. MSGCU's youth visa has a 12.75% fixed rate. That means if you sign up today, if you come back 5 years from now, if you come back 10 years from now, 20 years from now, and you still have that same credit card, you know, an updated version, but it'll still have 12.75 interest rate. That's what's written into the contract. A variable rate loan, and variable rates you'll mostly see on credit cards or mortgages. That interest rate can change. It can vary, right? It can go up or down. It's based on the economy. If you're listening, oh, inflation's going up and the inflation is sky high right now, and oh, interest rates are going up. Well, right now interest rates are going up. I don't know how all that comes together and makes that decision, but right now interest rates are sky high. Luckily, yeah. If it goes down, so does your rate. So, well, which is better? You know, is a fixed or a variable rate better? Well, it depends on the situation. We're going to get into credit cards later, but for youth being really anyone under 25, quite honestly, because that's just, you're still getting experience. Look for fixed. Always look for a fixed rate credit cards, fixed rate. You don't want surprises. You are a demographic who tends to not read the fine print or not ask a lot of questions, and signing up to a variable rate can mean it just gets higher and higher and higher and higher and higher and higher, and you can't do anything about it, you know, unless you close the card. So how much is the interest rate? What's the APR? And is that a fixed or variable rate? It's very important. Fixed rates are easier to budget for, right? Easier to plan. It's consistent. Variable rates, it could go down. I mean, some people may try to convince you, oh, you get a variable rate because the interest rate might go down. It's not very likely. It's much more likely that it's going to go up before it goes down. Just because the index goes down doesn't mean the rate you currently have will go down. It means the new rates that are offered to new loans are down. All right. So that is a very basic overview of getting loans, of general loans. What's some terminology you need to know? What should we be looking out for? As we move forward, we're going to spend more time on individual loans, specifically how do mortgages work, specifically how do student loans work, you know, specifically credit cards. They all have their own thing. So this is a great introduction. Ms. Cureton, did you have any questions or anything to go back and elaborate on?
We are talking about the interest rate being either fixed or variable. Fixed is set rate, variable meaning it could go up or it could go down. Now, who determines whether or not that rate goes up or down? Is this when the government, when you hear them on the news saying, you know, they're increasing the interest rate? Is that what determines whether or not your variable rate will rise or fall?
That's a great question. The answer is yes, and so yes, depending on the type of loan, if it's a variable rate mortgage, there's certain rules and it can only go up by a certain amount, in a certain period of time. If you have a credit card, a variable rate credit card, as the economy changes, it's the government, it's the credit card company itself that decides whether or not they want to raise your rate. It's not that the government is telling them, well, you need to charge that particular customer more. It's the credit card company's response to the government is, oh, we're going to have to raise these people's rate. And your specific financial behavior can help determine your rate, as in missing a payment, making a late payment, trying to spend over the limit may be seen as, well, those are no-nos, and we're going to charge you a 1% more interest rate, or we're going to raise your interest rate because you made this mistake. I've seen that a lot of times. I've seen people on the phone screaming, I've had this card for years, how dare you raise my rate because I made, one late payment. So read the fine print, ask questions. It is based on outside sources that you cannot control, but be careful because it may continue to go up based on your behavior as well.
Good deal. Are there any other questions, comments? Well, all right then. If there aren't any more questions or comments, then we will bring this to a close. Great presentation as always, Colleen. Thoroughly explain and give a complete understanding about the various types of loans and the things that can affect whether or not you get good interest rates and whatnot with the loans that you're trying to take out. So thank you so much. Thanks everyone for joining, and we will see you all next time on College and Career Pathways. Everybody have a great day.